Welcome to Growth Investing Mastery. Today we'll be reviewing our February 2025 portfolio. And as a reminder, this is not investment advice or recommendations to buy any stocks. My portfolio allocations at the end of February have AppLovin as my top confidence position. That's 20.6% of my portfolio. And then I really have three companies that are tied for the next confidence positions, which are Hims and Hers Health, Astera Labs, and Reddit. The symbols are HIMS, ALAB, and RDDT. And those are all in the range from 16.4% up to 17.1%. My fifth stock is Paymentus, which is also high confidence, and I'd probably have that as a little bit higher percentage if I had more free cash to allocate. So if I end up selling or trimming somewhere else, I might add a little more there. And in the middle, I have three medium confidence positions: Credo at 5.6%, that's symbol CRDO; GeneDx, WGS, 5.3%; BioStem, BSEM, and that's 2.6%. And then there's three lower confidence or newer positions that I have, and I'm kind of learning more about these companies as I go. Cineverse CNVS, 1.3%; Ardelyx, ARDX, that's 1.2%; and Raspberry Pi, RPI.L at 0.9%. My cumulative return since January 1st, 2024 is 144%. In 2024, we were up 146%, and this year so far we're down 1%. And actually just a few weeks ago, we were up 28% year to date, so you can see it's a pretty steep decline. And when the market goes risk off, a lot of times growth stocks get hit hard. Thankfully, we only sold one company recently, and the rest of the companies delivered pretty strong results, but the price fluctuated down pretty strongly. One interesting thing too, when you look at compounding, I would have thought losing 1% from 146% would bump me down to 145, but when I ran the numbers, it's actually 144. So it shows compounding works in the negative way too. So if you have a big gain and then you lose 1%, it's 1% is actually a little bit bigger than you might realize. Let's review the portfolio updates for this month. I added to AppLovin, Astera Labs, Paymentus, Credo, and GeneDx. And I sold Zeta Global, which we'll get into the reasons I sold that company. And there's two new positions: Cineverse, CNVS, and Ardelyx, ARDX. And this month saw like a ton of market volatility. At one point, my portfolio was up 28% for the year, and it's given back most of those gains actually. And one topic I wanted to talk about quickly is avoiding euphoria and despair cycles. And this means when your stocks are going up, a lot of times you want to check your phone or see it going up, and you're kind of thinking like, wow, this is almost like too good to be true. That's something we want to avoid, and something I'm looking to kind of correct in the future. When it was going up every day, I was checking a lot, and then that makes it harder on the down cycle. And something Mark Douglas, who talks about investing psychology, talks about this a lot. Why getting in like a euphoric or despairing state is bad for us, because it kind of cuts off our logical aspect of thinking through investing. But we want to use that emotion as a signal. So if you're feeling, almost too good about your stocks, you might want to cut back on checking the prices all the time. AppLovin is a very high confidence position for me. They had very strong Q4 earnings with revenue growth of 44% year over year. And their profitability metrics like net income and EBITDA are growing even faster. After the earnings report, the stock price got up to over $500 a share. And I trimmed a fair amount then, because AppLovin was getting to be a huge percentage of my portfolio. It was at 1.24%. So I trimmed it back, and later in the month, there was a short report, and that gave me the opportunity to add back some shares when they went under 300. And basically, there was a report by this company called Fuzzy Panda, which I wrote through the whole kitchen sink. So they said all these different things about the company. One of them was, and the headline was, that they don't comply with the App Store rules, which I know to be bogus, because I've been following AppLovin since 2022. And actually, my first impression of AppLovin back then was also this kind of like, seems like a gimmick on mobile games, like it's taking ads. And I was thinking like, this doesn't seem like a very durable business, although the profitability was really strong on the business. And I kept wondering like, how is this company making so much money? So when I see a few years later, somebody has that same kind of concern that I initially had. And I got through like all those blockers of really investigating this business. I had a lot of confidence this short report is really nothing. A lot of times these short reports are well timed, like, after earnings, after the stock sinks. And it went down like another 20%. And I mean, I think, the realistic risk that there's even anything valid in this short report might be, 1 or 2% or something like that. So when it drops 20%, that's often a nice opportunity to add if you're really confident in the company. And one thing that's happening with AppLovin is the company's getting viewed by a wider audience of investors. So before, when it was a $10 billion company, very few people had heard of AppLovin, except if you're in mobile games. Even the CEO is often on record saying, we don't do any marketing. The analysts used to ask him all the time, like, when are you going to start marketing? When are you going to start marketing? And he would say, we're just not marketing it. The product sells itself, basically. And that's one of the things I like. The e-commerce pilots had really strong results. There's a lot of buzz on Twitter, which the CEO has talked about, where people are saying the ROAS, or that's return on ad spend for this company, is incredibly strong. And they only have 600 customers on the e-commerce pilot, but it's not open to the general public. So they picked out some bigger businesses to trial this on, and the results are really strong. It's also incremental to meta ads, meaning it's not taking away from meta ads. And that was something the short report also tried to assert. So just like the short report was just full of inaccuracies, and they try and, make 20 different accusations and hope something sticks. But the market did react pretty strong. And also, one thing to know about AppLovin is they used to be actually making the mobile games themselves, and they're selling off that business. That business is actually still profitable. It brings in maybe 60 or 70 million dollars of EBITDA a year, which is like decent for a business which basically runs itself. They weren't making any more games. But yeah, this is my top confidence position. The next company we're going to look at is Hims and Hers Health, symbol HIMS. They had a really strong report where revenue landed at 95% growth year over year, and they guided the next quarter to 91% year over year growth, which in a normal market, that would be a big rally in the stock. But currently, there was a lot of momentum priced into the earnings. It got up to maybe $70 a share, and then it's now sitting about 40. So it dropped pretty hard after that. And the stock trades heavily around GLP news. So anytime the shortage of GLPs is resolved, HIMS typically drops pretty large. But I think the concerns there are overblown because the rest of their non-GLP business still grows at 43%, which is already a very strong number. And they have a lot of new initiatives with at-home tests. And they acquired another pharmacy, a 503B. They have this 503A and 503B. It's just different types of pharmacies that they own, and they control all like the supply of it, and they work with the FDA. There is some increasing competition from Amazon and this other company who's a direct competitor in the telehealth space, Ro. They have a partnership with Lilly for their GLP. So these companies like Novo Nordisk and Lilly, they're definitely feeling the pressure from Hims and Ro, like who are just selling compounded GLPs, which is a generic form. And there is some misconception about this company in the market, I feel, where they often use the term knockoff, or this is like off-brand or something, or they use this kind of like derogatory term to say that Hims GLPs isn't safe. But Hims complies with good manufacturing processes, which is like a strict standard. They work with the FDA. Everything I've seen has shown like the business is pretty legit in terms of their safety and things like that. I think a lot of the negative bear things do come from other pharmaceuticals, though. So there are maybe some things that are not 100% positive on this company, but I'm still very positive about the company overall. Astera Labs is another high confidence position I own with the symbol A Lab. They had a really strong report with revenue at 141 million. That was up 179% year over year and 25% quarter over quarter. And I wrote here the market was not impressed by the results. So it was down maybe 15%. And usually before I see what the market reaction is on a company, I write in my notebook what I think the stock will do. And I had written down that the stock would go up 20% based off the headline numbers. So it's definitely kind of a bearish market right now for growth stocks. Usually my predictions on that type of thing are like, they might be 5 or 10% off, but it's rare that I'll be, a whole differential off of like, I think it's up, should be up 20% and it's down 10 or 15%. Um, the quarterly call was really strong. They didn't really see any like deep seek issues or like algorithm type things. And I think with NVIDIA systems like having some heating issues, Astera Labs is going to play really well with their solutions, which address some of those like thermal issues and other kind of data issues, memory issues that hyperscalers are seeing when they're building their newer systems. And the business is hiring a lot. They're really small right now for like their market cap. They're 250 people, a 12 billion market cap. That's actually something I really like to see revenue per employee pretty high. And they are going to scale up quite fast to maybe 500 employees, it sounds like. It just seems like business is booming for them and they need to hire because either they don't have enough sales reps or maybe they want more R&D. I'm fine with all that, although I mean there could be some growing pains is how I would put it. When you hire that many people that quickly, the company culture can change and stuff. So that's something to keep an eye on. They had guided for 151 to 155 million of revenue next quarter. And I think this is what the market didn't like. It's only up 10% sequentially from that 141 million. But typically, this company has actually they've beaten every quarter they've reported. They're somewhat recently public about a year ago. I think they went public in March of 2024. Um, so it's a newer company, but they've beaten expectations every time, and they're fairly conservative with their guides. And I'm pretty positive they'll get like 160 or above. If they didn't get reach that, then I would probably be looking to trim or sell maybe. But that's just something to keep in mind that the guidance is often sandbagged a bit. One really interesting thing from the conference call was they projected Scorpio, their new product line, to be the highest revenue product soon, which was a surprise to the analysts. A couple of analysts asked about that and said, how do you have such confidence in Scorpio and it's surpassing Aries, their other product, which is quite big already, their main revenue contributor. So that was a positive surprise that they have a new product and that's expected to become very, very big. Reddit with symbol RDDT is a high confidence position. And the company seems on track from their latest earnings. Everything looked decent, although there's a lot of seasonality in their business. I didn't understand actually that Q4 is typically their strongest quarter and Q1's their weakest quarter. So what happened was they reported a pretty strong number. I think revenue was up 71% year over year, but they guided to sequentially down revenue. And that's because in Q4, a lot of shopping happens, a lot more advertising happens in Q4. And I think the market was kind of unprepared for that headline number of revenues going to be down going from quarter four to quarter one. The stock sold off a bit. It got up to like $220 a share and then closer to 200. It now sits at 160. And I think that's actually a decent value there that it's come down a bit and it maybe deserved to cool off a little bit. I had a big run up. And Reddit's becoming a more well-known name. A lot of the younger generation uses Reddit as a kind of social media on community or sort of a replacement to Google in some ways if you want to search for what people are actually saying about something. They have a lot of unused ad space and new ways to expand the platform. And they keep mentioning they're only running ads in like 10% of comment sections, which I keep wondering about, why are they not just ramping up the ads? And their CEO has been very cautious about ramping up ads too fast. He says he doesn't like social media that has a lot of ads, so I think he's being very cautious. But I've mentioned before, like that Reddit can really use this as a lever. If they, even getting close to missing guidance, they could just up the number of ads in the comments to make that number. So I think they're playing it conservative. There's a lot of upside as the company scales up, and they have partnerships with OpenAI and Google who are buying anonymized data from them. So there's quite a lot of room for expansion for this company. Paymentus with the symbol Pay is a company I bought into after their last earnings, which was really impressive. They've been onboarding a lot of enterprise customers to their payment solution, and many of those customers were kind of scrambling to onboard faster than they expected. And that's a really positive sign when you see enterprise companies, they want to onboard a SaaS product very fast. Usually, in the current environment, a lot of CTOs are kind of dragging their feet on spending on software. But in the case of Paymentus, it's actually delivering a strong ROI for the companies. So they want to get onboarded faster. And the previous quarter, 3 months ago or so, was 232 million of revenue with 14.4 million of net income. And that's in contrast to a market cap of 3.4 billion. Usually, if you look up any other SaaS player in the market, if they have 230 million of revenue, they're probably a 10 billion or a 15 billion dollar company. So I do feel that Pay is potentially like overlooked by the market, and maybe analysts aren't as familiar with it because it's not as popular a SaaS product. But I've been really impressed with their investor conference calls. They had these are non-earnings calls, but they had these conferences where they presented, and they just really made it sound like business is booming. And a lot of what I'm going to do with this stock is going to depend on what they report on March 10th. Since I've only owned this company for basically one quarter, I really want to see if they can continue the momentum. And the stock price since I bought it has drifted down quite a bit. I bought it around maybe 35 after that last earnings report, and it's gone down to about 27. So, why it's it can be concerning. The market is giving some signal that something might be off here, but I think it's more that the market's just ignoring this company. So hopefully they're going to report strong numbers on March 10th, and we'll see where we go from there. Credo, CRDO, is a medium confidence position for me. They're going to report earnings next week on March 4th. And the reason I got into this company originally is they had guided revenue sequentially to go from 72 million to a range of 115 to 125, which is absolutely insane. That would be 67% quarter over quarter growth in revenue. And they're in the AI hardware space. They're kind of maybe a competitor to Astera Labs or adjacent to them. They play in a slightly different space, but their products do have some overlap. And Credo sells a lot more to Europe and Asia than Astera Labs does. Astera is more kind of this traditional IPO, and Credo did a bit more of a pivot in their business. They became public a lot earlier. Credo's on the hardware side a bit more than Astera, so they have a little bit lower gross margins. They're also based out of the Cayman Islands, which is kind of not ideal. It doesn't have as strong regulations. It's something to keep an eye on is like how that corporate structure looks. It's kind of a yellow flag on this company, which is preventing me from getting to a bigger position. But I really want to see what they report mainly. And a lot of the price action, I think, is going to depend on where the company guides next quarter. So even if they land at 125 million, if they say they're only going to get 140 million next quarter, like the company's probably going to tank because the company's a lot of the results were pricing in a strong outcome, but the stock sold off pretty heavily actually recently. It went up to maybe $80 a share, and it's down at 50 right now. And I think 50 is actually a pretty good buy for this company. I like the prices there myself. GeneDx, symbol WGS, they had really strong quarter four results, which boosted the stock from about $75 a share, maybe 80 up to 110, and now it sits at about 105 or 100. It's one of the few growth companies I've seen this earnings season who's had a strong result and seen that very big rally follow through. A lot of companies have presented strong results, and the rallies kind of faded as the general market faded too. They do gene-based testing, and they're entering the NICU and pediatric outpatient space a bit more. I do feel this company is undervalued by the market. They're earning over 100 million of revenue that's profitable, GAAP profitable, and the valuation's still around 2 billion. If you look at other competitors, Natera, they have about a 23 billion market cap, and they have 400 something million of revenue. So I do feel there's some upside on the valuation here for GeneDx. They are expanding into adult genetic testing, which can potentially add to the total addressable market. And I have a full video deep dive on this company, which is my last video, if you want to learn more about this company. BioStem, symbol BSEM. It's a medium to low confidence position that I'm still learning about. They do wound care products, and that's really taking off. Their gross margins are over 96% because the source material is basically free. It's they call this company a biologics company, and that means basically that the product is made from like some aspect of like humans, pretty much. And I put here the fate of the company depends on NASDAQ uplisting. So the company is listed on the pink sheets And I was trying to research why they're originally on the pink sheets, and it seems like they got that way for lower regulations and less like filing requirements. But everything I've checked on, whether it's their investor forums, investor relations pages, and how their conference calls look, I mean, everything looks like they're reporting exactly like a NASDAQ company. It doesn't seem like a budget, finance team or something like that. And I think there is a lot of upside to this company if they do get uplisted by NASDAQ, but that is the biggest question mark. So I'm probably not going to be increasing this position too much until there's further resolution on the NASDAQ uplisting. They applied in September of 2024, and I'm not really sure like how long this process typically takes, if it's supposed to be 6 months or something, or at one point we should say like, okay, this is turning into like a darker yellow flag, or maybe, like, why aren't they getting uplisted already? So that's the biggest risk with them. But they did post preliminary results of nearly 103 million of revenue, which is up 794% year over year. And that's not a typo. It's basically because their product launched recently. So if you look back a year, it's like they hardly had any revenue, or they're just maybe sampling and stuff like that. Their official earnings report is early April, so we'll wait and see what they say there about the NASDAQ uplisting. Cineverse, symbol CNVS, is a low confidence position that I just started. And they're a microcap movie studio. And they say they've cracked the code on how to kind of get these blockbuster movies. Normally, this isn't an industry I would typically invest in, but when you look at the numbers on this business, it's quite compelling. They have a lot of quotes in their latest earnings call about stunning the industry. They had this movie Terrifier 3, which sold 54 million at the box office with just 500K of marketing, and their revenue is 41 million. That's up 207% year over year, and surprisingly also net income positive. So they made 7.2 million dollars in the quarter. The market cap is absolutely tiny, so that, I mean, that's something to keep in mind if you really want to invest in a company this small. It's a $50 million company. They are listed on the Nasdaq, and their story goes back quite a while. I think they went public in early 2000s, and they had a different strategy, as obviously like streaming hadn't taken hold. But what I really like about what they're saying is they have this Moneyball strategy for theatrical releases, and it's based off proven IP, they call it, or proven movies. They know they're going to do well. They have a huge social media presence, and they have this podcast presence, and they say they know how to reach fans. A lot of their movies are in the horror genre, which is Terrifier 3. But there's just so much they're saying about how they've cracked the code, and like this is only the first one. It is the biggest risk for the company too, if it actually is a one-hit wonder and management's just kind of overselling people. But they do say on the conference call they continue to believe our stock price is undervalued with significant upside. Usually you don't see that too often. The last time I remember seeing a company say this was AppLovin, maybe a year ago, and even analysts were saying about AppLovin, like, why are your results not respected in the market or something like this. And then, a year later, the stock is up 400, 500% or something. So it is positive when a company says that. They might be kind of like tipping their hat that like stronger results are likely to continue. Ardelyx, ARDX, is the next company I own. They're a biotech company which has two FDA approved drugs, one for IBS and the other for chronic kidney disease. And the reason I've got so interested in this company is they've had really strong accelerations across revenue, net income, and EBITDA. So when I look at the revenue pattern, or basically the last 5 quarters of revenue, it goes all the way from 34 million up to 116 million, and that's 238% year over year. And EBITDA has this very nice pattern too of 5 quarters ago was minus 28 million, then going to minus 24, then minus 13 to 3, and then to 9. So now they're profitable, which is really nice for a company this small. The market cap is 1.25 billion, which is very small for a company that's earning over 100 million of revenue and is profitable. And one stat that really stuck out in my mind from their last earnings call was I don't know how to say this, IBS Rela maybe, or Ibs Rela. It's up 32% quarter over quarter growth. So it seems like that drug is really taking off. They have a number of other things in like stage 2 FDA trials. I don't really, want to count that before something lands and gets approved. But another thing I like, it seems like they have a technology platform. It's for small molecule therapies, which I don't know very much about, to be honest. But it's a proprietary drug discovery platform, and hopefully this is a company which has figured out kind of a new way to deliver medicine. And if they do have a superior platform, maybe they can continue innovation and keep getting those FDA approvals and expand more. The last company I own is Raspberry Pi with symbol RPI.L, and that L means they're traded on London. And they're a microcomputer maker that has 70% of sales coming from industrial now. Previously, they sold mostly to the educational and hobbyist market, but they're a small profitable company and revenue is growing 61%. It's a still pretty small market cap and they measure in pounds. I think it's about maybe 1.3 billion pounds. They went public recently, so I think this is going to be their second report. And they met on April 2nd. And they measure it in halves, so they're going to report their H2 of 2024. That's just one subtle difference of the London exchange where you only have to report twice a year, although some companies do report 4 times a year on London. There's also probably a fee to be paid if you want to get into this company through your brokerage. And it makes sense to route the order to London rather than buy it on the pink sheets. And I'll maybe do a deep dive on this company later. I want to talk about a company I sold called Zeta Global, symbol ZETA. And they actually had a really strong quarter in Q4 where they landed at 50% year over year growth. But there was a lot of asterisks next to that number. Mainly, this is a political spend quarter, and they have a lot of marketing AI tools, and there was a huge amount of political spend. And they also have an acquisition, which was playing into this current results. But where the market kind of and myself didn't like this report was they guided on the weaker side, I felt, for upcoming quarters. So Q1 was guided for 30 to 31%. And I had really kind of thought from the last quarter that this company might be a company that's getting into that kind of organic 40% growing range. They could be guiding light or very conservative. That happens with a lot of companies. Um, but what had originally got me interested in this company is their Q3 report was they kept saying how strong Q4 was going to be and like how crazy good the results were. And I was hoping that wasn't just from the political spend of the, every 4 years in the US or something. But it does appear like they're kind of projecting that way because they guided the full year revenue growth to 23 to 24%. And then I think they backed that out to say if it was without the acquisition, it would be closer to 20% or 21%. Um, but they are lapping, like in 2025, there's not going to be much political spend. So they are lapping a political spend quarter. But this is where it gets really tricky trying to figure out is this company doing really well without the acquisition and without the political spend. So it's hard to get those apple to apples numbers that we want to see. Um, in the end, I just didn't have a lot of confidence with this company. And I'd really like to stay under 10 stocks total. Planning to do a video on that soon about the ideal number of stocks, but I was already up to 11 stocks and I just kind of rather have the funds move to other high confidence positions. And a lot of my other stocks were dropping just with the general market. So there was definitely, I felt some bargains on some other companies. Although like the sell was kind of like, I felt a little bit on the fence at first because, when they get 50% year over year growth, it's pretty impressive. I do expect the company to still do pretty well and they seem undervalued to me. So I don't think this is a bad company to own. But it definitely like got into that sell territory where I'd rather have my money elsewhere. And just wanted to leave with some final thoughts here. The first is that growth investing is very high at variance, and this can show up in a single month like it did with February, where the first half of the month was up almost every day, and then the second half of the month was down a lot. And one thing we want to focus on is company results over price changes. So as long as our companies are delivering strong results, and a lot of them are, I only sold one company, we're generally pretty happy with holding those companies. And what'll happen is strong quarterly results over time that they're going to force the stock price up. So it kind of acts as a coiled spring if the market pushes the stock down, but the results are good. Eventually, maybe the next quarter or 2 quarters later, it's likely the stock price is going to pop and go up very, very fast. Sometimes it can go up, 2x or 3x very quickly because people begin realizing, well, like this company is undervalued now, whether measuring on price to earnings or price to sales. So that's my final thoughts for this month's portfolio review.